morning, everybody. Welcome to our Thursday discussion. Today we've got Vaughan Henkel and we've got Fiso, the analyst dealing with the property sector for them, talking to us. And we're specifically going to be talking about Redefine. It's not often we get a smaller company, share price-wise, that's showing some potential. But we're looking forward to hearing from you, Fiso. I'm sure Vaughan will allow me to let you kick off and take us through your presentation. Thanks very much.
Right, over to you, Fiso.
All right, thank you, Sarel. Good morning, everyone. Again, my name is Fisokuhle Mbatha, and today I'll be taking you through the company update report for Redefine post their interim results. So we'll jump straight into the executive summary. So Redefine released its interim results on the 8th of May, and the market didn't like the results at all since it was down 6% on the day, and analysts revised their growth estimates downwards on the day post the results. So we update our intrinsic value from R5.40 to R4.67, and this is primarily based on a weak macro as well as an operating environment. So the weak macro part primarily speaks to the top line growth. And the operating environment speaks primarily to cost growth. So the tone is going to be relatively the same throughout, where we are expecting cost growth to outpace top line growth. Just to speak a little bit on the operating environment. So there, the costs are primarily in load shedding, property costs, those are rates and taxes, as well as interest costs from debt being rolled over in the current high interest rate environment. So we forecast low top line growth based on weak fundamentals on the SA assets. So we see Redefine as being SA biased. So most of the growth is going to come there, but we're seeing the EPP expansion also contributing growth on the top line as well. So we maintain our buy recommendation based on an upside, despite the conservative estimate. We'll speak a little bit on the valuation part of the presentation. So in terms of the investment thesis, again, Redefine is SA biased, so the local portfolio should see some low to flat top line growth, and that's based on the weaker fundamentals. The top line, the weak fundamentals speak largely to the top line. So if we look at it from a segmental basis, we start off with. Sorry, could you mute a bit? It's I'm not sure if that's feedback or what.
Don't worry, we'll find the person and mute them. Carry on.
Again, so just to speak on the weak fundamentals affecting the top line. So if we take it from a segmental basis, or we look at a retail first, for instance. So the weak macro there affects the consumer, given the high interest rates as well as inflation, which trickles down to the tenants, which Redefine has. The retail sector as well also takes a bulk of the load shedding expenses, since retail is the most exposed to the effects of load shedding. And as the load shedding crisis continues and the levels increase as well, the efficiency of the backup power becomes less efficient and the costs grow as more diesel needs to be burned. In terms of the office, so office has changed drastically throughout the sector as a whole because of the type of office space that is demanded now for the company Redefine. We're going to see that the vacancies for office have remained relatively stable. And then the question then becomes, is that a good or a bad thing? But given the current environment that we're in, anything that isn't a detraction is good news. In terms of the industrial segment, so industrial has remained pretty resilient before, throughout, and post the pandemic. But we'll see there is a little bit of a detraction in their vacancies, and it seems that's a result of a big tenant vacating one of the assets for Redefine. But management has given the tone that they expect that vacancy to be occupied by the end of the next reporting period. Sorry, Vaughan, can you just go back to the investment thesis? And then in terms of the EPP vacancies, so they're not at pre-pandemic levels, and what that does is it provides a good base for growth given the current tenant retention, the collections, and the rental reversions in that area. So the EPP is primarily retail, and the strong current retention, the collection, and the rental reversion speaks to strong fundamentals given the high inflation in the region as well as the high interest rates. And overall, what that does is the weak macro puts pressure on the top line growth. The operating environment costs aggregate to higher cost growth, and what we're seeing there is a margin contraction, and that's why we expect the FFO margin to contract from 44% to a weighted 39%. can jump into the next slide, please. So just to touch a little bit on the results, the main talking points there. So we saw revenue being up about 36% and distributable income up 7.2%. And what it does is it speaks a little bit to what the earnings quality looks like. And I mentioned before, the tone remains the same. What we're seeing is cost growth seems to be outpacing top line growth. And that's why we're seeing that the revenue growth at the top is being lost in the income statement. Again, it's primarily through the operational costs, through load shedding, as well as property costs. We're seeing interest costs due to rollover debt also having an impact on the bottom line, as well as fair value adjustments as well. And then in terms of the portfolio vacancies, we're seeing them slightly decrease, and that's because of the industrial segment of the SA portfolio again. So Redefine is SA biased. It's a good portion of the results, and speaking to the same tone for the industrial management expects that vacancy to be filled. So we can expect the portfolio vacancies by the end of the reporting period to be slightly better. International vacancies have decreased from 3.5% to 2.9%, again, showcasing the stronger fundamentals in the Polish region amidst a weak macro environment in the European region as a whole. What this speaks to is the offshore investment has a lot of growth potential in it. The LTV went up from 40.2 to 40.9%. It is still within management's medium target range of 38 to 41%, but it is on the higher end of the range. And the tone that management gave is that they expect the LTV to be sub 40% by the end of the reporting period. And even at that point, it would still be relatively high when compared to the industry average. We saw dividends per share being down 14.2% as well. And then in terms of the outlook and guidance from management, we saw the payout ratio guidance being maintained of between 80 and 90%. It was 85% for the interim period. But we saw the distributable income per share guidance being guided downwards, and management is attributing it to increasing costs in debt, as well as property expenses. So we're seeing the tone being relatively the same here. Cost growth looks to be outpacing top line growth. Could we jump to the valuation part, please? So now when speaking to the valuation, so we're seeing a 37% upside, and that's despite the conservative estimates here, where we expect the margin to contract, given the expectation of much lower top line growth, while the cost growth continues to forge onwards. We expect the macro to continue to be difficult, and management expects the exact same thing. And we're seeing that from the tone of the dividends, the distributable income being revised downwards. And what exactly would change our minds in terms of the fundamentals of the company? So what would change our mind would be a better macro environment as a whole. This is to outpace unavoidable cost growth. So the primary costs here are the load shedding costs will continue to be an issue, and with the levels increasing again, the efficiency of the backup generating power becomes much lower, but the costs associated become much greater. Debt having to be rolled over in a high interest environment means the interest costs increase as well. And then we have property costs, which are continuing to increase. These are costs that are from one perspective or a little bit out of control of management. So the better macro would be supportive of top line growth to outpace the cost growth, which puts a little bit of pressure off of the margins, or we could see a margin contraction. And up until the better macro starts to unwind, we can see the top line growth outpacing the cost growth. Our stance on the fundamental of the company remain relatively the same. However, we still do see a upside from a valuation perspective, and that's why we maintain our buy recommendation. That's it from me. I think we can jump into the Q&A if there's anything else left.
Thanks, Fiso. Let's just jump across to Shaun on the technicals, and then we can do the Q&A if you guys are happy. Shaun?
Yeah. Good morning, everybody. Yeah, so you can see this is a year chart of Redefine. I'm calling it bearish at the moment. It's trading below its 200-day moving average. You can also see it long term is trading sideways, and that's that blue line is a resistance trend line. I think it's at 421. That's the upside of the sideways market. And then we've got this lower support zone between 360 and 367. Sorry, 345 and 335, and that's where we're trading at the moment. I saw it open a bit lower this morning. So, we anticipate the support level to hold and anticipate the price to bounce from here. You can see at the bottom there, you can see the MACD, the oscillator, is pretty oversold. And you can see by the previous cyclical low, we anticipate a turn from here. So I anticipate a bounce back to the 21-day and 40-day moving averages. And our intrinsic value, as Fiso said, was 467. So we still got roughly about 37 to 40% upside potential. So I'm giving this a early nibble for those of you that are contrarian investors to get in. Thank you.
Thanks, Shaun. Over to you, Sarel.
Thanks, Shaun. Thanks, Fiso. Yeah, with the flipping margin contracting, like Fiso said, and Shaun's technical report, it certainly does look bloody, considering that we've got load shedding they have to contend with, they got rising rates they have to contend with. We're already a lot lower than what our bear case suggested on your table there, Fiso. But certainly somewhere it has to find its feet. Not saying boots and all, but like Shaun said, maybe time to start keeping a closer eye to it. Maybe if it makes a higher high 2 days in a row, then we'll see that little bounce that Shaun was speaking about. You can type your questions into the chat, or you can just raise your hand and then ask them. We'll give you a chance to speak. Please put on your camera for us so that we can put a face to the voice. I see Swadesh was early out with the gun here this morning. He typed it before the presentation started. He said, "Good morning. Do we know the percentage revenue split between the Echo Polska portfolio and the SA portfolio? How much revenue is derived where?"
Just to answer that question quickly, so it's about 15 to 20%. Currently, it's about 16% in the interim results, the split in revenue.
Okay, so majority of money comes from South Africa still.
Yes, the portfolio is SA biased at the moment.
Okay. See, Rajesh says, how does this match to Growth Point? Which is a better rate to invest in now, he says.
So I'll jump in now and then I'll hand over to Fiso. So we have Growth Point in both our SA equity portfolio and obviously our property portfolio. We think obviously Growth Point is large in the index, but we also think it's more representative, and don't underestimate, and I'm going to hand over to Fiso now, is that you had a poor set of results, but you've got a very cheap company here. So that's sort of the summary of the two. Growth Point we think is sort of higher quality. Fiso, do you maybe want to comment there?
Yeah, I think you said a majority of what I wanted to say as well. Growth Point is in the portfolio, given we think it's a better quality company. It's a little bit more representative of the sector as a whole. But when you're looking at a Redefine, I mean, the margin contraction, cost growth, outpacing top line growth, where the current share price is now, is relatively cheap. There looks to be a lot of upside. So that's why we still maintain our buy recommendation.
Thanks, Fiso. JB, I see you got your hand up. Fire away.
Yeah. Good morning, and thanks for a wonderful presentation. What's your view on management here? They haven't done a great job, management, and I'm always concerned about management here. Since Mark Weiner passed away, I just think this thing hasn't really done well at all.
I think what we end up having to really look at here is management is a huge consideration in terms of how we look at the quality of the company, but really another factor of it is whether the fundamentals of the company are continuing to work the way that they should. I mean, if we look at the results right now from the SA perspective, they were pretty flat, pretty stable, not that great because the market didn't perceive them to be that great. I mean, the share was down 6% on the day. So what we think about the company as a whole, even though there was the management change, still maintain the exact same view because the fundamentals, though weak, seems like the company is relatively cheap, and it's how we maintain our view, really. If we can't get a good view of the management, we want to look at whether the business model continues to work the way that it should, whether the fundamentals of the two portfolios, EPP as well as the SA portfolios, work the way that they should work. That really influences our stance in the company as a whole.
Thanks, Fiso. JB, I hope that answers. Any other questions, guys? I don't see any in the chat. No, it doesn't look like it. Guys, it looks like it's a short one today. Thank you very much for sharing with us. Thank you for giving us your insights. Thank you to everybody who's joined us. I hope you have a great Thursday, and we'll see you again next week. Thank you very much. Cheers.
Thanks, everybody. Cheers.
Cheers, everyone. Bye-bye.